Welcome everyone to Vested Interest. It is the first day of February. We're going to take a look at AFLAC today. Big drop on the day. This one is out of the financial sector. This is a insurance company, like a gap insurance to bridge between what you might have through your work and other coverages. That's kind of what they focus on. And if you are new to the channel or you just have not taken the time to do so, it would really help me out, really help out a small YouTube channel like me with the YouTube algorithm. If you hit that thumbs up, hit that subscribe button down below, and make sure that you ring that notification bell so you're notified whenever we put out any new content. It doesn't cost you a thing. It really does help me out. It'll cost you, I guess, 1 second of your time to do that. And drop a comment down below. Let me know what you think of AFLAC. Let's jump into the video. This is the Vested Interest Stock Screener. This is how I set up the videos. It's also how I look at a company on a high level to see if it's going to make it on my watch list. If it does make it through the criteria, 5 of 8 if it's not a financial company, I add in price to book. For banks primarily, you can use price to books for companies like Aflac. You would just want to compare a company like Aflac to like a MetLife or an Allstate, another insurance company in a similar vein. You can pause this and read through here for my criteria. I'll talk through it as we go through the video. And back to AFLAC, if you want to know more about this company, which you should know the business, that's where you should start, www.aflac.com. Check them out there. That is their homepage where I pulled that information from, and that's www.aflac.com. That is their homepage. AFLAC is a Fortune 500 company providing financial protection to millions of policyholders and customers through its subsidies. In the U.S. and Japan, when policyholder or insured gets sick or hurt, AFLAC pays cash benefits promptly for eligible claims directly to the insured unless assigned otherwise for more than 6 decades. So they are a insurance company. AFLAC volunteer insurance policies have given policyholders the opportunity to focus on recovery, not financial stress. So for example, my company, I have insurance through, but they, for some things, will only pay 85% or 90%. AFLAC would be like a gap insurance to cover that additional cost, that 10% that your work insurance might not cover. And it's accident insurance, cancer insurance, right? So a lot of insurance programs won't cover. Like if you were to get cancer and die, it might not be as big of a benefit if you were to, get hurt or accident or something, because they consider it an act of God. Critical illness, especially if you didn't have cancer before you got the insurance. Critical illness insurance, life insurance, right? So additional life insurance your job might offer. I think mine offers $250,000. And if I want anything above that, then I have to go outside of it. Hospital insurance, again, for stuff that wasn't covered by the hospital. Short-term disability insurance, dental insurance. This one right here is an important one for people who, like me, I have short-term disability, but it only pays 85% of my wages, so I lose 15%. So if I wanted to go get additional coverage, I could go to AFLAC and say, hey, I want you to cover my additional short-term disability insurance, dental insurance, supplemental dental insurance, and vision insurance. So they offer a lot of insurances just like any other insurance company, but they really focus on that gap insurance, the bridge between what your company might give you or what you're buying through another provider and what they don't cover. And the reason we are taking a look at them, down 9.71% on the day, huge drop on the day, down $8.19, closed out the day at $76.15. We are talking about Aflac Incorporated, ticker AFL, out of the financial sector. This is an insurance company. And 52-week range as low as $60.20, as high as $86.20 as well. And currently, after hours, they're down even more, 1.25%. So closer to their, about midway between their 52-week low and 52-week high. Average volume 2 million. Today's was 9 million. So a lot of people jumping out of this one. Market cap of 44.501 billion. The beta is not available. I'll try to find that in another source and link that down in the comment section down below, or if someone can drop it down there if you would. Price to earnings ratio, $9.79 per share. Nice earnings per share on this one, so pretty low. You'd want to compare this one to, like I said, companies like MetLife, Allstate in that sector to see how their PE ratio stacks up. Earnings per share, $7.78 per share. Earnings date, February 1st, so that is probably why they dropped today. Either bad earnings, missing the top line and bottom lines, one or both, or they may have even hit both and just have bad future outlook, right? So sometimes they'll drop on future outlook even whenever they hit the numbers. I have not looked at that, so I'll take a look at that and see what's going on there. And if you are interested in this, this company, you should be probably doing that as well. Ex-dividend date would be February 20th, so if you were interested in this one, you could still buy it all the way up to February 19th to be able to get the next dividend. And 1-year target, at least according to Yahoo Finance, $83.54. So they see it going up a little bit here over the next calendar year. Now we're going to look at dividend yield theory, look at dropping the statistics, go down to dividends and splits. We look at the 5-year dividend yield average, 2.37%, compare it to its current 2.37%. Oh, they're equal. Over here it says forward annual dividend yield, 2.37%. So since they are the same, since they are equal, that speaks to fair valuation on this one. So if it was to drop below $76.15, which it is in the after hours, it would be starting to present some value there, but you might want a larger margin of safety. I think whenever I did the math, it was $79.23 or thereabouts for it to be within 15% of this 52-week low here. So I would be looking at this one under $70 per share if I was looking to get into it and try to get it within 15% of its 52-week low. And then it would be showing a little bit, at least according to dividend yield theory, margin of safety. Low payout ratio on this one, only 21.59% payout ratio. So they have a lot of room to increase this dividend over time, pay down debt, make acquisitions, other reinvest back into the company. Now we're going to get into the financials a little bit and just look at free cash flow, but there's a lot of good information here: balance sheet, income statements, debt to equity ratios, their assets over liabilities, is their revenue growing over time? You can check their margins. Just very full of information in the financials you should be looking at if you are investing in individual companies. For our particular purposes, we're going to look at free cash flow. We want growing free cash flow over time because typically if we have growing cash flow, we have growing dividends to match. 2020, they were at $5.9 billion. 2021, down to $5 billion. But it does look like they increased the repurchase of their capital shares, so that might account for it. You'd have to do some math there. 2022, 3.8 billion, so definitely down. So really you're seeing a downtrend here from 2020, a little bit down in 2021, further down in 2022, because this repurchase of capital shares definitely does not account for that drop. And so far in 2023, they haven't rounded out the year yet, but 3.3, so they might be around that 3.8 or 4. But overall, I would say decreasing free cash flow on this one, which would be a bit of a concern. They are repurchasing their own shares, right around 1 to almost 3 million this year. But again, that does not account, other than 2021, it doesn't really account where they went from 1.5 million to 2.3. It does not account for it in 2022 or 2023 so far. Now, I always recommend more than one source. So another one I like is stockanalysis.com. What we were looking at before on the previous page was Yahoo Finance. I'm not affiliated with both, but make sure you're looking at more than one source so you can make sure, the information you're getting is accurate and up to date. So we're still talking about AFLAC. They have 12 analysts that have taken a look at this. They call it a consensus hold. I would tend to agree. Again, I would want to maybe look at this one under $70 per share, so it's got a little bit more to drop in my opinion. They have a low estimate of $74, which would be a 2.91% decrease from where it currently sits. An average estimate of $78.27, which would be a 2.66%, and a high estimate, which is pretty much in line with what we saw for Yahoo Finance there on the previous page, of $84, and that would be a 10.21% increase in the stock price. Now, statistics, we're going to get in here and look at how financially efficient this company is at reinvesting its capital back into itself. For that, we look at return on equity, ROE, and return on invested capital, ROIC. Return on equity, I like 10% or better. This is sitting at 22%, so it meets the metric there. Return on invested capital, I like 10% or better there, and this one's sitting at 16%, so meets those metrics. So far, everything looks good except for the current price. Again, I would be looking for it under 70 per share. Now, I like 5% or better EPS growth forecasted over the next 5 years. This is only at 2.13%, so not quite where I want it to be. And I don't like that they have negative revenue growth of 1.44%. So that might be part of the reason they have decreasing cash flow. Their revenue is decreasing as well. Here is their dividend history going back to 2021. Again, very low payout ratio, 26.21. I think it was shown a little lower on the Yahoo Finance slide. That's all right, in the 20% range, under 30%, so still have a lot of room to increase the dividend. And they are raising the dividend at 8.64% on average. They are a quarterly payer. They pay out on March, June, September, and December. And going back to 2021, February, they were paying 33 cents. February 2022, they raised it up to 40 cents. February 2023 up to 42 cents, and it looks like they are raising it again this February up to 50 cents. So 8.64% dividend yield, very low dividend payout ratio, starting in around a 2.3% dividend yield right now. I would wait a bit low 70s, under 70 is really where I would be interested, but you make up your own decisions on that one. Well, that is really it for this one. Let me know what you think about AFLAC down in the comment section below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, hit that subscribe button. Join us here on this journey to financial freedom. Join the vested interest community. It really does help out a small YouTube channel like me whenever you hit that subscribe button, you hit that thumbs up, and you drop a comment. Share with anyone you think that might find value. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Aflac you'd like me to add to the Stock Pick of the Day series, drop it down below and I'll work it into the rotation on a day that it pulls back. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you had a great week. We will see you in the Sunday. This is the last one for the week on Thursday here. So we will see you on Sunday morning for the portfolio update. Actually, I'll probably see you Saturday morning for the dividends and options paid out in January. I probably will get that video out to you either Friday afternoon or Saturday midday. So look for those two. That's another reason to hit that subscribe button, hit that notification bell, and drop a comment. Let me know what you think of the video. What do you think of AFLAC? Is it in your portfolio, or are you avoiding it altogether? I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount not comfortable losing. Always do your own research, invest based on your situation, circumstances, and select criteria, or seek the advice counselor, certified financial advisor.